Hello, I'm Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We have a great show for you this morning, and of course, if you have any questions, send them to Brian Rezny at ReznyWealth.com. And do make sure you visit our website and download any of our groundbreaking reports. In fact, we have a new report right now, 3 big investment risks investors must avoid now. That report is free, and it's available at ReznyWealth.com. You know, I want to talk a little bit today about the real reasons most investors underperform or really don't make money on their money. There's been numerous studies, not only from Morningstar, an independent rating service on investments, Delbar, another study that's been done for about 3 decades, about investment returns and investor returns. And what's interesting is most investors, and I know some of you might be saying maybe that's not me, it probably is. It shows that the majority, high percentage of investors make usually half or less of what the stock market makes or the bond market makes because of various decisions, bad decisions, emotional decisions, bad strategy or no strategy at all. I want to cover some of those today because one of the ultimate things you need to do as an investor, whether you're 30 or whether you're 80, is make a meaningful return on your money. If you make a couple bad choices in your life, whether it's getting out of the market at the wrong time or buying overpriced investments and then they go down a lot, that could wreak havoc on your overall long-term return. At my firm, I'm happy to say that we always educate our clients on the proper ways to have their money managed and to make sure they make good decisions instead of bad decisions. Today's show is all about you making quality decisions around your money so you have the best chance to make a return on your money. Emotional decision making is a big one. You know, anytime the market goes up a lot, what I find is investors want to go up and raise the risk level in their portfolio. When the market drops 10 or 15%, what I find is investors then want to reduce risk. The exact opposite of really what you should be doing. As an investor, you need to pick a strategy and pick your risk profile and stay with it. And realize that over a 3 to 5 year time frame, as long as you stay within your strategy, you're going to have up years, you might have some down years, but overall you have a great chance to make a return on your money. Emotional decision making, when things drop or things are really good, either chasing return or basically selling at the wrong time, will wreak havoc on your portfolio, and I will guarantee you, you're not going to make money using emotional strategies. The lack of long-term discipline approach or a strategy that's being followed. And again, at our firm, we're a money management firm. So we actually manage our clients' money, unlike insurance companies, unlike banks and brokerage houses that basically really just sell investments in a brokerage account. What we do as a money management firm is we actually manage our clients' money using a disciplined approach. We have to follow that approach. And the reason we follow that approach, because if you follow a strategy, a set of principles that have been proven, you have a very, very good chance to make a return on your money and maybe a great return on your money. But following no strategy at all, which is often what I find, especially people that work with Wall Street firms or do-it-yourself investors, are shooting from the hip, buying whatever hot at the time, only then to be cooled off and make lackluster returns or losses in their portfolio. Chasing what's hot and not what's right. Remember 2000, technology was all the rave. Technology stocks were trading at better than 100, 125 PE, price to earnings ratio. And of course, technology stocks cratered. I remember getting calls from lots of people from past radio shows back in the day, and people saying, Brian, should I be loading my boat in technology? Should I only buy technology stocks? And I would say to people, don't do that because that's a big mistake. You're chasing something that's already hot and already overpriced. And of course, people that chased technology in 2000 lost a lot of money. Of course, in 2008, same thing. People were chasing real estate type investments and they lost a lot of money. And parts of the equity market, of course, also went down in the Great Recession of 2008. You as an investor never want to chase what's hot. You want to buy what's right and what's of value. Sometimes one of those investments may lag, or your portfolio may lag for a short period of time, but if you're always buying the hottest investment that's overpriced, that's a guaranteed recipe for you not to make money or make little money and lose a lot more. Overloading the boat. Basically, chasing a couple different stocks or a couple different sectors and putting all your money into that. I find this happens a lot. Somebody will buy a particular stock, it goes up 30 or 40%, let's say in a year. Well, they'll look at their other parts of their portfolio and they'll say, wow, those didn't do as well. I'm going to sell those and put all that in that individual stock or a small group of stocks, only again to be burned. Remember, if you overload the boat and those 1 or 2 or 3 investments don't do well, everything does poorly, and you again suffer. These again are studies that came out of Delbar and Morningstar, and a lot of other good research shows if you over-concentrate your portfolio, you're not going to do well and you take a lot more risk. Your advisor being emotional and not following a strategy either. I find this happens a lot. Half the clients that hire my firm, Rezny Wealth Management, come from the brokerage houses and banks and the insurance agents. These people, for the most part, aren't following any strategy at all because most of them are truly just salespeople within a brokerage account selling investments. So what happens is they're often more emotional and nervous than you, even the investor, and they're going to tell you to do stuff that maybe is not right emotionally for your portfolio. I remember a big client that hired me not too long ago that basically lost hundreds of thousands of dollars because their advisor at one of these Wall Street firms got emotional, told them to liquidate their portfolio at exactly the wrong time, only to have the market come back up 15 to 20%. It probably cost them close to $400,000 in lost money because of the emotional decision their broker or so-called advisor made in their behalf. You must be disciplined or you will fail. I've talked about this so many times and tried to educate investors for over 30 years. You have to be disciplined, and sometimes that means buying value even when things are down a little bit. I know it's tough to buy cheap and sell high, but most investors want to buy high and sell low. You as an investor need to stay disciplined, and one of the best ways, in my personal opinion, to stay disciplined is hire a real money management firm, somebody like Rezny Wealth Management, which is a fee-only money manager. If you're unable to manage your own money, if you maybe don't have that discipline or the strategy, or you're finding that your current broker or advisor is not keeping pace with your goals, it's time you called Rezny Wealth Management. Let us look at your portfolio. Let's do a review. Let's find out how we can help better your situation so you're better able to meet your retirement goals and all of your goals for hopefully a very successful retirement. As an investor, you have to remember strategy, follow a strategy, never let emotions ruin your portfolio, and you've got to be disciplined so you have a best chance to make a return on your money. I want you to go to ReznyWealth.com, download any of our groundbreaking reports, or sign up for a consultation with my firm. Office is right here in Naples and in Fort Myers, in addition to the East Coast of Florida. I'm going to take a quick break. I'll be right back with your questions after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Is your so-called advisor really just an annuity salesman? Fact, annuities are sold by misleading you, the investor. Sky-high expenses, crazy surrender penalties, and mediocre investments rob your returns and rob your security. My advice, stop being sold. If you want real money management, real advice, call my firm today. And we're back, and of course we're going to take your questions, send them to Brian Rezny at ReznyWealth.com. This show is all about you, the investor. If you're finding the advice you're getting is not working, if you're finding you have lackluster returns on your portfolio that are not meeting your goals and objectives, if you're finding the advice you're getting is less than advice and more sales, call Rezny Wealth Management for a consultation, get that needed second opinion, Don't go it alone, and as I always say, never ever settle for bad advice. Your retirement security is far too important to waste it on bad advice and a bad advisor. Judy from Estero, Florida. We have most of our money invested in real estate. We are selling now. Can you suggest somewhere to put the cash as we sell properties? We are in our 70s. Judy, great question. One of the things that I want to stress is you're obviously going from real estate, individual real estate, it sounds like now, and you want to do other types of investing. Have you ever done other types of investing? Have you ever managed your own money other than maybe the real estate you're currently selling? I would suggest, because you probably have a fairly sophisticated situation and a fairly large portfolio, I would suggest you call my firm and schedule a consultation at one of our offices here in Florida. But to answer your question directly, what you want to do is build a portfolio based upon your risk profile and your goals and objectives. I would utilize what's called an ETF, exchange traded fund. There's many different styles and types of ETFs or exchange traded funds that basically can diversify a portfolio. You can build a portfolio out of those that will help diversify the portfolio, help give you the opportunity to grow the portfolio and produce the needed income. I'm assuming your real estate before was providing the income and or growth or combination in your retirement years, so your portfolio that's going to be set up now has to do the same thing. There's many different sectors. What I would suggest, again, call our office, schedule a consultation. It sounds like you have a fairly complicated situation. It would make a lot of sense to sit down with one of our professionals and really talk about your portfolio and specific needs. Michael from Florida. I've listened and loved your show for over 7 years. What ETFs would you recommend for a 26-year-old son for $80,000? Michael, excellent question. What I would suggest is this. Your son's young. He's 26 years old, so he really should be hopefully a growth investor. I'm assuming he can handle a little bit above average volatility. What I would suggest you look at is small cap in the U.S., and I would also combination with that large cap as a buffer, and some emerging market exposure. ETFs can have an excellent way to diversify the portfolio, and there's many in the small cap, large cap, and in the emerging markets. One of the things you have to understand is because your son is, of course, young, he has a long time to invest. He should be able to accept some of that daily, weekly, or monthly volatility in order to grow the money. And one of the best ways to do it is look at where the large cap companies have been, which used to be smaller cap companies. These are really the growth engines of the U.S. equity market. So maybe take a look at a 40% allocation in small cap, a 40% allocation to large cap U.S. dividend payers, and then use the remaining 20% in a diverse emerging market ETF. This way you've got the growth potential around the world, emerging markets, coupled with the staying power, in my opinion, of the U.S. marketplace overall. That would be a very important combination that will have your son have the best opportunity to grow that money for his future needs and retirement. Kathy from Miami, Florida. I'm 64 and I only have $50,000 in savings. I'm retired and not interested in long-term investing. I'm looking to invest $35 to $40K. I want something very safe. What would you suggest? If you want something very safe and you're not really looking to long-term invest, the best thing you could really do is go buy yourself a 1 or 2 year CD. What I would recommend is take half of your money that you want to invest, put it in a 1 year CD, put the other half in a 2 year CD. When the 1 year CD comes due, roll that into a 2 year CD and keep rotating that portfolio 1 year, 2 year in a combination fashion. Because what you are looking for is safety with no volatility from your question, and the only real investment that's going to give you the safety that you probably are looking for is a CD. I'm not saying that's a great investment, but because you're looking for safety and not long term, a CD is going to be probably your best option for the safety mechanism. Dan from Naples, Florida. Are American retailers doomed? My concern is about some non-traded real estate trust I own and the risks they have. Dan, yes, a lot of U.S. retailers and retailers really around the world are really doomed. I've talked about this a lot. It sounds to me like you own a non-traded REIT, non-traded real estate investment trust. That's what REIT stands for. These are risky ventures. I've always really strongly encouraged investors never ever be sold a non-traded REIT by your brokerage firm. By the way, brokerage firms love these because they pay the brokerage firm, the underwriting fees, and the actual REIT itself very, very high fees and commissions. I do not like non-traded products because you can't get out when the situation changes. So what's happening is this. Real estate in the U.S. and really around the world, general real estate, brick and mortar, is starting to disappear slowly. In fact, this year had the highest so far year of bankruptcies and closures of retail storefronts. If your REIT owns a lot of retail and they start losing tenants from bankruptcy and there's less people going back into these buildings, you've got a bunch of vacated real estate holdings in your non-traded REIT. What does that do to the value of your asset? It goes down. What happens to your cash flow? It also goes down. Guess what? You can't get out because your broker sold you down the river for a lavish commission. Never, ever buy a non-real estate investment trust, a REIT. You can buy publicly traded ones, get the same benefit, but have liquidity, meaning options to sell at any time you choose. Don't let your broker take away your financial security. Stop being sold non-traded REITs, investors. You'll be glad you took that advice from me. Barbara from Naples, Florida. Would ETFs would be better for TIPS? TIPS are Treasury Inflated Protection Securities, folks. And which ETF would be best? What I would suggest is this, Barbara, because interest rates are very low. We have anticipation that rates are moving up, and of course this year rates have already been scaled up a few times and anticipated in future years to have rates go up as long as the economy stays strong. Remember that. What TIPS are is a component of interest rate and a second component tied to inflation. So you get an interest rate payment, you get a secondary payment that's tied to inflation, they add together. And if you are going to buy a TIPS ETF, do your own research, buy one that is short-term in nature, usually less than 3 to 5 years average maturity, the bonds they own. Because if you buy a long-term TIP and rates move up, your value will drop, and it will negate the interest rate you make and also the secondary component, which is the inflation component that's added onto that rate. Stay short-term in TIPS, and as bonds go, stay short-term in general, because rates are low, folks. If you're a bond investor, you could be hit hard in future years if rates start moving up the way they're anticipated. Manny from Cape Coral, Florida. How will Trump's tax proposal affect the muni bond market? Excellent question, Manny. Realistically, this is what happens. If the Trump agenda is passed on tax reform, and the brackets come down, it will have a negative impact on municipal bonds. The reason is municipal bonds are tax-free. The lower the tax bracket, the less beneficial bonds become, especially muni bonds, because you're not getting, you're basically not in this high tax bracket anymore, so the benefit of the tax-free interest is not that great. I would anticipate muni bonds, and we've already started to see this, just from the talk of taxes, we've already started to see bond values going down on the muni side and or stagnate. So what I would say is this: if you own a lot of muni bonds, investors in general, you need to review those bonds should some be sold before maturity. If you're thinking about buying muni bonds, you may want to wait till really the tax plan is passed in full and give it a couple months to shake out afterwards, and that way you can reassess how the values of muni bonds are affected and if interest rates at that point are also changing in the net account for you. Too often, investors buy bonds because they think they're safe. Bonds, remember this, folks, can have a lot of volatility. In fact, at times, they can be as volatile as the stock market. So you investors who think you're buying something that's safe with little volatility, might be getting yourself into trouble. And muni bonds can have a lot of volatility, especially longer-term bonds. I'm going to take a quick break. Make sure you go to ReznyWealth.com, visit our website. I'll be back with your questions after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Is your broker working in your best interests, or are you being sold inferior investments by Wall Street firms and annuity salespeople? My advice, never settle for bad advice if you value your financial and retirement security. Real money management, real advice is the difference my firm provides. Call us today and schedule a consultation. And we're back, and of course, we're going to answer your questions. Send them to Brian Rezny at ReznyWealth.com. And make sure you do visit our website, ReznyWealth.com, so that you can download any of our groundbreaking reports. Our newest report, 3 Big Investment Risks Investors Must Avoid Now, is free, limited time offer. Go to ReznyWealth.com. Get your free instant download copy. It is a must read for any big investor who has a portfolio of at least $500,000 and higher. It's important that you read the report, understand the current risks I see in the marketplace, so you can better be able to act to those and protect your portfolio and retirement security. Josh from Florida. Hello, Brian. I'm thinking about investing in ETFs. By the way, again, folks, ETFs, exchange traded fund, and was wondering if you had any good recommendations on emerging market ETFs, small caps, and also all around ETFs. I'm looking for growth type ETFs. I enjoy your TV show weekly and your radio shows. Thank you. Josh, what I would tell you is this. If you're looking at, there's thousands, literally thousands of ETFs out there. Some I would never invest in because they're low volume. Stay away from those. But if you're looking at specific ones, look at things like the IJR, the iShares IJR. Fair disclosure, we do own that in managed accounts at Rezny Wealth Management. Maybe take a look at the Vanguard VWO is another one in the emerging market economy. As an all-around, especially in the Europe area, VGK right now by Vanguard is another one that's all around Europe. We do own positions in all of those currently. Those would be areas that you may want to take a look at, do some further research, see if those fit into your overall strategy and what you're trying to create. Remember, no investment is buy and hold, meaning you don't buy it for the rest of your life. You may buy it today with the intent for holding it the next 1 to 20 years, but something may change in the middle and it may need to be sold for better opportunities. I always stress, follow your investment strategy, research your investments daily, and if you're not able to do that, find a real investment management firm like Rezny Wealth Management that can do the heavy lifting, take the burden off your shoulders, and do the research that needs to be done. But change an investment in your portfolio when necessary if there's better opportunities for that money. Maurice in Fort Myers, Florida. Thank you for your show. I understand what you're saying about bonds and interest rates. I keep seeing articles that money has been poured into high dividend bond funds, otherwise known as junk bond funds. How can this be explained? Maurice, a simple answer. People chase yield. Investors are called yield starved right now, meaning because interest rates are way down, what you used to make on bonds or bond type investments is very low. So investors are scouring the landscape trying to find something that's paying them higher dividends. So people have gravitated a lot towards high yield or junk bond funds. This is a big mistake. High yield bonds or junk bond funds act very similar and have very similar characteristics of risk as the U.S. equity market. It can be as volatile. In fact, it could drop as more or as much as the stock market in the next recession. Traditionally, high-yield bonds or bond investments are great opportunities when you're coming out of a recession. When we came out of a recession in 2003, excellent time to look at high-yield bonds. When we came out of the recession in 2009, excellent opportunity to buy high-yield bonds. I personally think today high-yield bonds are greatly overvalued. Investors are accepting a tremendous amount of risk, in my opinion, for very, very, very little return. I would stay away from high yield bonds, but remember, investors buy investments based upon what they perceive the future return's going to be, only because they looked at what it made in the past. They assume that's going to continue, which is no guarantee to the future. Remember, past performance is no guarantee of future results. But investors never listen to that. They always buy what's already been hot and overvalued, only to be burned on the way down again. Isidore from Tampa, Florida. Are mutual fund investments in floating rate loan good at current income and today's interest rate environment? Isidore, we actually like floating rate type. These are called floating rate loan funds or floating rate bond funds or bank loan funds. We like these, and let me explain why. Bank loan funds or floating rate funds are very short-term paper or instruments. So they're not going to be hit as hard when rates move up. In fact, they can actually do better when rates move up very slowly because the paper is typically 90 days in length. So we do like floating rate bank loan funds or bond funds. In fact, we own some of those currently in managed accounts at Rezny Wealth Management. Our positions can change at any time, I will stress that, but currently we like those. I think it's an opportunity for investors who are trying to diversify some of their portfolio out of traditional bond or bond investments. Floating rate might be a good place to position some of your money for interest income in a rising interest rate environment or potential. David from Punta Gorda, Florida. Thank you for your television program. Is there a difference between an ETF and a mutual fund? Yes. Generally speaking, mutual funds are kind of old school. Mutual funds, generally speaking, have a cost structure often 10 to 20 times annually higher than an ETF. You could look at a mutual fund as an example that has an average annual cost every year to you, the investor, of 1.25%. I can pick a very similar ETF that has a cost structure of 0.05% or a tenth of a percent, significantly cheaper than what a mutual fund is. Also, ETFs are more liquid than mutual funds. They can be sold anytime throughout the day. They're typically passive in nature. I like ETFs as a tool in a portfolio, far superior, in my opinion, and lower cost structure than mutual funds. My advice, when you're ready for your financial interest to come first, let's talk. Let's review. Let's put your family's security first. Call us today and schedule a consultation. Some of you out there, maybe a lot of our listeners, are concerned about the advice they're receiving. Maybe that advice isn't up to par with your goals. Maybe your advisor is more sales than real money management. Never, ever let bad investment advice affect your retirement or portfolio. Never wait, and I always stress, I know change is hard, but just give us a call. Schedule a consultation. Get a second opinion. Go to ReznyWealth.com, call the number on the bottom of the screen, schedule an appointment. You will be glad you did. I'll see you next week.